Time now to get over to Evan Lucas at IG in Melbourne for his thoughts on the overnight action. Evan, let's start over in the United States because that's certainly what a lot of people are talking about this morning. We heard from Ben Bernanke, we had some private job numbers out and also GDP. What of those three things were you most focused on?
Yeah, very interesting night, obviously, over in the US as well. The other thing that probably added a little bit more of another sort of kink in it was the end of July, and therefore it was also a bit of window dressing going on from the major hedge funds sort of in what they were offering as well. And you can see that in the price action in the last 2 hours of the S&P. It absolutely took off and then dropped off very, very strongly into the close and finished only up, basically dead flat or a solitary point if you want to have a look at that. The reason for it, if you have a look at the Fed was a very interesting sort of meeting last night. They did come out probably slightly more dovish than most people would expect. They changed their language from to modest, from moderate. We also saw absolutely no more or any form of tangible idea of when they're going to actually perform tapering. That is quite important. It means they've got their finger on the pulse and they know that the market is probably well and truly geared up for what's going to happen in September. Most are expecting them to taper around about then. We probably see them more likely coming out and saying that they will taper in September and going ahead with it in either October or November. The other interesting thing that they've obviously now managed to really factor into the market, which is also very important and probably why we saw not a huge amount of movement overnight either, was if you have a look at the forward future rates for Fed rates in June 2015, they actually held completely dead true to what it was before the meeting at 52 basis points. It's currently at 10, which means they have now got into the market a whole idea that they are not going to move on rates for at least 2 years, maybe even more. And that therefore suggests that the Fed and now the market are well and truly line on line, knowing exactly what's going on. And it means the volatility we've seen in the movements coming out of the Fed is on the way down. So
Evan, it seems like he's got that message across. We should focus on this. It seems like he's finally communicated to the market that tapering doesn't equal tightening. We've been talking with a few US guests this morning and they said it seems like finally the market's digesting the commentary as it should, and as you said, both on the same page.
Yeah, and that's the most important thing that's coming out. So it means we can now concentrate on other things. The one thing they've also obviously put in there as well is inflation. It's probably still not as important as unemployment, but it's certainly starting to touch almost on a level pegging. So all in all, relatively interesting sort of news. The GDP numbers were slightly better at 1.7%. It means the market and also the US economy is sort of also getting out from the drag from sequester that came into sort of effect in January, February. So good results in terms of how the market is actually reacting to that. So all in all, the US market overnight did finish relatively flat, but it does mean we're not going to probably see the kind of volatility we could have seen 2 months ago and last month as well in Asia and Europe today, considering what we have seen out of the Fed over that last period of time, Kate.
OK, we've got a stack of numbers out today. Manufacturing from all over the globe, really. We'll be focused on the China numbers. We've got official numbers out, an official read, and a lot of the commentary I've read suggests that we could see it move into, well, the index, the government index, move into negative territory or contractionary territory for the first time in a long time. That means below that 50-point level. Do you see that occurring?
Yeah, we do, and it'd probably be the first time we've seen it in around about 25 months, if I remember having a look at the reads this morning. That will be a fairly interesting situation to see. It means the bigger end of town in China is also contracting. We know about the HSB flash numbers that came out last week, and they're also being revised again today at around about 11:45 Australian Eastern Standard Time is when we'll see that data coming out at 47.7 last week. It could even go in under slightly more, but looking at those official figures, we do expect around about 49.8. That will mean it's the first contraction in a very long time, and we understand why. We know what's going on over in China. They are wringing out speculative lending. They are also cracking down on also fraudulent invoices, and all that will mean that over the next couple of months, particularly in China, there will be some fairly interesting data, is probably the best way to describe it. It will mean we'll see them slowing down, and that will probably drive the Aussie dollar lower than it already is. We have seen it at a 3-year low this morning at 89 cents, and it could drop well and truly into the bottom end of that 89-cent handle as well on that kind of data. Having a look at that also, it will be an interesting data for the Australian market as well. We do have commodity price year on year coming out, and that will be well and truly influenced by that Chinese data figure. It is expected to contract. We have seen that across the year, that is moving lower. And considering next week is the start of earnings season, a lot of people are hoping that the cyclical stocks, particularly those material players, can actually do some sort of punching higher with their results. But a sort of a bad figure there may actually dampen sort of expectations for the next sort of 4 or 5 weeks, and that may also influence the material space, particularly on the trade today.
Okay, Evan. Local market today. Let's talk about some opening calls. At the moment, SPI futures are pretty much flat as a tack.
Yeah, and we're sort of seeing that as well. It will mean, and I have read a couple of reports, one of them are coming out of Goldman Sachs. If we somehow manage to punch higher today, it'll be the 9th consecutive day of actual gains, and we've only ever done that twice in history. The last time was actually back in January this year, and then way back in March 2010. It does suggest that there is sort of some good momentum in the Aussie market, but in saying that, there are a few bits and pieces that may actually drag us slightly lower. We do know that the iron ore price is actually now ticked just below $130 a tonne, and that may drag on the materials place. Other thing that happened last night after market was Suncorp came out with some relatively interesting downgrades to their guidance for full-year profits, around about 480 to 500 million compared to consensus of 583 million, and they're going to put out a special dividend as well to sort of offset the issue. So that may also see the financial services space be in a little bit of a sort of unwinding position as well. So that may end up pushing us slightly lower, and maybe we might not see that 9th north print.
Okay, Evan Lucas, IG, thanks so much. Always appreciate it.
Thanks, Kate.
And as we were saying just there, a really flat session, at least at the close for Wall Street. But